Well, actually, it's a great question. You know, given what we've talked about today so far, is we are likely to have unhappier property investors as time goes on, because retailers' ability to pay is getting squeezed. So if we don't see, you know, robust top-line growth, and you need to continue to invest in your business, and all your other costs are going up, then your ability to pay more rent is just not there. So you're going to have retailers, tough discussions on renewals, tough discussions on new deals. I see coming up, I'm sure that there are investors who are buying you know, properties at low cap rates, and they've done their performance, they've dialed in some rent increases to get their IRRs, and they're going to be disappointed. I think that's what we're facing. I mean, the reality is, you know, we have walked away from deals and said, this, we're not doing it. You know what, we're in business to make money, and if we can't make money, then we're not going to do the deal. It's going to be that simple.
Jim? Yeah, I think looking 5 years and beyond will be the issues. Is whether you look to 5 years or beyond 5 years may change your perspective on the question relatively significantly. The industry association on whose board I said that you mentioned earlier was dealing with retailers and retail marketing related issues, and invited RioCan, Oxford, and Cadillac Fairview to sit on a panel along with Perry Keiko, one of the better known retail industry analysts, to discuss what's going to happen here. And all 3 landlords said, don't look for significant increases in supply over the next 5 years. So guess what happens when that happens? We'll be knocking on the door. And we won't be nasty about this or opportunistic about this, but guess what's going to happen? That was as close to hand-wringing with glee I've seen a public meeting of that sort, with the expectation that, and you mentioned Kohl's and JCPenney. I'd like to suggest some other names that could be sitting on that label as well, that could be looking for incremental space or looking at acquisition of Canadian chains, which would include Macy's. Belk's, for those of you who may not know them, is one of the dominant chains. They're just not as close to the Canadian border. And Tesco. And these are capable, well-financed, good retailers, some of which work in multiple countries and understand those adaptations. So the temptation will be incredible for some landlords to say, I'm going to be opportunistic in this space, and it will have 2 effects. The first is that it will boost rent for the specific properties or store within a mall that they're dealing with. It'll have the spillover effect, if that's an anchor tenant, on the rents for the others who weren't part of the transaction in the first place, because that's what happens if we've got a better anchor. I'm going to help you with bringing in a better anchor for you. And the second, and the additional collateral damage that will come from that is potentially very dangerous in the short run. That is, within the 5-year window before significant amounts of new supply could be built. And you have to be careful about wanting to build significant amounts of new supply, because our total population is still only going up by about 250,000 people a year. Is that every municipal tax assessor in the country is going to say $150 a square foot for Zellers now becomes $400 a square foot for Target or whoever else. That's going to create more revenue for this, a higher value for the property, and so we're putting everybody's taxes up. And we'll see you in 3 or 4 years when Bob Langlois has collected his fees and restored sanity to the marketplace. The little retailers will be the ones who really take that one.
We're only so easy.